All right. So in this lecture, we are going to do IAS-12, which is income taxes. And again, one of the most important standard for your FR exam or the F7 exam. Because again, this standard is going to be tested both in the objective test case questions as well as the final account question. And you know this thing, when I say the final account question means the question in which you will be required to prepare the financial statement, the statement of profit or loss, the statement of changes in equity, the statement of financial position. So there you will see IAS-12 as a compulsory adjustment because I don't remember any question of the final accounts in which we are not having the IAS-12 adjustment. So in every question we are having the taxation adjustment. So in the notes and the additional information, you will be getting an adjustment related to IAS-12, the taxation. So when we are talking about IAS-12 income taxes, this is simply accounting for taxes. Like when you talk about the companies, obviously they're supposed to pay the tax. When they're supposed to pay the tax, they will be accounting for those taxes. They will be recording those taxes within the financial statements. So how those taxes are recorded within the financial statement is being described within IAS-12. So IAS-12 is basically the accounting for taxes. When we are talking about the IAS-12, you will be dealing with two types of the taxes. The first one is the current tax, and the second one is the deferred tax. Remember this thing that this standard is simply based on some calculations. Like when we are talking about IAS-12 in FR exam, the examiner will be simply testing your knowledge that how you are going to account for those taxes. For example, the current tax. The current tax is simply the current tax provision. We call it as the current tax provision. Now, why we call it as the current tax provision? Why we are calling it as the provision? The answer to this question, sorry, is simply that the companies are required to pay the tax in advance. Like ideally, this should be the case that, for example, there is the year end, and after the year end, they should calculate their tax, and then they should pay the tax. First, they need to calculate the tax, and then they need to pay the tax. This should be the ideal situation that, okay, you got the year end, you have finalized your financial statements based on your profit, you have calculated the tax, and then some adjustments are being done with the taxation authority. And now when your tax is being accepted by the tax authority, you just simply pay it. But this is not the way we deal with the taxes. Why this is not the way we deal with the taxes? Because the taxation authority requires the companies to pay the tax in advance before the year end. It can be quarterly installments, it can be semi-annually payments, etc., whatever the law is. I'm not talking about the particular law, it may be anything. So when the taxation authority is requiring the company to pay the tax in advance, now that means you need to estimate your tax, because they are not waiting for the year end that the profits has been calculated and then you are calculating the tax. They're not waiting for that particular moment. They're just requiring you to pay the tax in advance. Now, when they're requiring you to pay the tax in advance, that simply means you need to estimate your tax. How you will be estimating your tax? Simply, for example, based on your estimated profits. Now, how you can estimate your profits based on based on the past year. So you can simply estimate your profits and then simply estimate your tax. So that is why we call it as the current tax provision, because this tax is not the actual one. This is the estimated one. So at the period end, an estimated amount is therefore accrued based on the year's profit. Now, simply means that when you have calculated when you have estimated your tax, you will be simply recording it in your financial statements. Debit profit or loss. This simply means recording the tax as an expense within the statement of profit or loss. And credit goes to the tax payable. And when you're paying this tax, the next double entry would be debit tax payable and credit bank. So remember, first you need to book your tax within the financial statement. So this is the entry when the tax is being accrued and you are recording this within the financial statement. Debit profit or loss simply means you're recording this as a tax expense and credit tax payable. And when you're paying the tax, you are de-recognizing the liability, debit tax payable, and credit goes to the bank. This is the simple treatment of the current tax. You estimate it. That is why we call it as the current tax provision. And then you book it within your financial statement when it is being accrued. That means recording expense and the liability. And then when it is being paid, you de-recognize the liability and you credit the bank. This is the simple treatment for the current tax. But remember, this is the estimated one. Now, the point that should be noted is, like, for example, we are talking about 2021. For example, we are talking about 2021. We estimated the tax, which is the current tax provision. We estimated the tax. And when the 2021 will close, we now have the financial statements, we know the actual profit, and then we need to do some adjustments with the taxation authority because they are not going to accept all the things within that. There are so many things which the taxation authority is not going to accept, and they will be telling you, okay, do these adjustments. And even when those adjustments are being done, then you will calculate your actual tax. So that means in 2022, in the next year, you will get aware of your actual tax. This was the current tax provision. And your actual tax will be the story of the next year, which is 2022. Now, when your actual tax is being calculated in the next year, you will see that this tax is different from your estimated one, because obviously in most of the cases, you're not going to have the ideal amount, the same amount which you estimated in 2021. There will be a difference between the current tax provision and the actual tax. There can be two cases. When the actual tax is calculated and it is being compared with the current tax provision, there will be two cases. Either it is going to be the over provision. Over provision simply means that you booked more tax. You estimated more tax than the actual, and you have recorded more tax than the actual. And the second case may be the under provision. You provided less tax than the actual. More tax than the actual, that simply means the over provision. Less tax than the actual simply means the under provision. Now, the point to be noticed is that this was the current tax provision which you calculated over here. And when we say the estimated one, that simply means this is your accounting estimate. This is your accounting estimate. The judgments are being involved when you are estimating the tax. And when the actual tax is calculated in the following year, you will get aware that either it was an over provision or under provision, that you have provided more tax or you have provided less tax. And when you are aware now of the actual tax situation, whether it was under or over provided, you cannot change your 2021 figure, because we know then that when we change our accounting estimate, that accounting estimate change is done prospectively. We have already discussed this point in the other standard, that when we are changing the accounting estimate, change in accounting estimate, change in accounting estimate is done prospectively. That simply means you are not going to change the previous figures. Now, what I'm going to do, simply, I will be having the current tax of the 2022 as well, like the current tax provision of the 2021 or the current tax provision of the 2022 as well. We will be having the current tax provision of every year. Now, if any previous under or over provision is coming, that will be adjusted in the current tax provision. Like for example, when you're talking about this current tax of 2021, the adjustments will be done for 2020. When you're talking about the current tax provision of 2022, the adjustments will be done of 2021, which is either under or over provision. So in the exam, the examiner is going to give you a trial balance. In the final account question or in the objective test question, objective test case question, you will be having the trial balance thing, the trial balance. And when we know the trial balance has two sides, the debit side and the credit side. So if you're having a debit balance within the trial balance, if you're having a debit balance within the trial balance relating to tax, then this means this is an under provision. If you're having a credit balance within the trial balance relating to tax, that simply means over provision. So in most of the question, examiner is not going to tell you whether it is an under provision or over provision. How they will be writing in the exam, they will be simply writing in the exam, the balance in the trial balance represents under or over provision. So if you see that the balance is on the debit side of the trial balance, this represents an under provision. If you see the balance is on the credit side of the trial balance, this represents an over provision. And remember what I have told you, that every year you will be having the current tax provision. Like for example, you're talking about 2021. So the tax related to the 2021, which is the estimated one, is known as the current tax provision. Now from the previous year, we will be either having an under provision or over provision. So now based on the common sense, if you have under provided, that simply means you recorded less tax in the last year. The under provision will increase your tax charge because you booked less tax in the last year. Now you need to increase your tax charge with the amount, which is the difference between the actual and the estimated. If it is an over provision, that simply means you recorded more tax than the actual. Now simply what you can do is reduce your tax charge with the over provision. This is completely based on the common sense. You provided less tax in the last year, you're going to add the difference into this year tax expense. You provided more tax in the last year, you can decrease that amount from this year tax expense because you recorded more in the last year. So remember, when we are making an adjustment, the adjustment of under or over provision is not done in the same year, because you will get aware of under and over provision in the following year. So when you get aware of the under or over provision, you will be making the adjustments in the following year. So when we change the accounting estimate, we know that the change in accounting estimate is always done prospectively. That means you're not going to change now the previous figure. And in fact, you are going to make the adjustments of under and over provision in the following years. So if you're having a credit balance, this represents an over provision and should be credited to the statement of profit or loss. When we say the credit to the profit or loss, that means you're going to reduce the tax expense with the amount. When you're having a debit balance within your trial balance, this represents an under provision and should be charged to the statement of profit or loss. That means under provision increases the current year tax charge and over provision decreases the current year tax charge. Now we have two examples, and these are the exam style examples. And after doing these examples, you can simply attempt every question of the exam related to IAS-12. Rombell's tax department has estimated the tax charge for the year ended 31st December 2008 as 36,780. And they are simply asking us to prepare the extracts of the same year. So this means this is current year tax provision. The current year tax provision is 36,780. This is the estimated tax of 20x8, year ended 20x8. And this is your current liability as well, because we know that first we book the tax within the books and then we pay it. So it is your current liability. There is currently a credit of 1630 on the tax payable account. So there is a balance within your tax account, and that is a credit balance. And we know when it is a credit balance, this simply represents an over provision. And over provision reduces your tax charge. So you're going to decrease your tax charge by 1630. And this resulting figure will be your tax expense in the statement of profit or loss. So what is that amount? It is 35,150. This is your tax expense within the statement of profit or loss. And this current year tax provision is your current liability within the statement of the financial position. So remember, if this was the under provision, then we are going to add the under provision in the current year tax chart, because apply the common sense. Under provision means you recorded less tax in the last year, so increase your tax by that amount. You recorded more tax in the last year, so decrease your tax charge by that amount. This is purely a common sense. Now we have another example. Simple has estimated its income tax liability for the year ended 31st December 2008 at 1,80,000. So that simply means this is the current year tax provision. Current year tax provision. Be aware that in the exam, you are supposed to read the question properly. If you're not reading the question properly, you may misread it. So they're saying Simple has estimated its income tax liability. This is the estimated one for the year ended 31st December 20x8. So when we are doing the calculation of 20x8, so this is the current year tax provision. How much it is? It is 1,80,000. In the previous year, the income tax liability had been estimated as 1,50,000. Now, what is the previous year? Previous year simply means 31st December 20x7. In the previous year, it was 1,50,000. Previous year simply means 31st December 20x7. What is the requirement? Calculate the tax expense that will be shown in the statement of profit or loss for the 31st December 2008. This is the year we are currently talking about. So this is the current year tax charge, 1,80,000, which is your current liability. If the amount that was actually agreed and settled with the tax authority in respect of 2007, what was the estimated tax of 2007? It was 1,50,000. And they say the actual figures of 2007 were 1,65,000. Now, what I told you, compare the estimated with the actual. So the estimated tax of 2007 was 150. They realized they became aware of the actual tax in 2008. Now we can do simply the adjustment. In the A case, the first case, the actual tax was 165 and you booked only 150. So this represents an under provision. And you're going to add 15,000, which is the difference between the estimated and the actual in the 20x8 tax. So now the tax of the 20x8 will be 1,95,000. So this is the tax expense within the statement of the profit or loss. This is the A requirement. Now coming towards the B. Again, first of all, writing the current year tax provision. The current year tax provision is again 1,80,000, which is the tax expense of 20x8, and it should be recorded as the current liability. The second scenario is that the actual tax was 140 and you booked 150, you booked 10,000 more. This represents an over provision. And you're going to deduct 10,000 from the current year tax because the over provision reduces your current year tax charge. You booked more tax last year. Now you can do adjustment in the current year by reducing your tax charge. So simply you will be having the tax expense of 1,70,000. This will be the tax expense within the statement of profit or loss. So you see 195,000 in the first scenario, 170 in the second scenario.